$7 billion. That's what OpenAI loses annually according to recent financial disclosures. And if you're invested in tech stocks, AI companies, or considering positions in this space, this number should make you sit up and pay attention. Here's what that means for your portfolio, and in the next 10 minutes, I'll show you the exact revenue-to-burn ratio that pro investors are using to evaluate whether OpenAI's massive losses signal a bargain opportunity or a ticking financial time bomb. Let's start with the raw numbers. According to reporting from The Information and Bloomberg, in late 2024, OpenAI is burning through approximately $7 billion annually in operational costs. To put this in perspective, that's roughly equivalent to the entire annual revenue that OpenAI generated in 2023, which was around $80 million. By 2024, revenue projections suggested reaching $4 billion. But even if we take that figure as accurate, the company is still spending roughly double what it makes. Now you might be thinking, plenty of tech companies operate at a loss. That's true. Meta, Amazon in its early years, and numerous high-growth startups have all pursued aggressive expansion strategies that prioritized growth over profitability. But there's a crucial difference between strategic losses and unsustainable burning. Let me break down why OpenAI's situation is particularly precarious and why it matters for your investment decision. First, let's understand where this $7 billion is actually going. The primary culprit is computational infrastructure, specifically the GPU chips and data center costs required to train and run large language models. A single training run for a state-of-the-art model like GPT-4 reportedly costs between $50 million and $100 million. When you factor in inference costs, the computational expense of actually running these models when users interact with them, you're looking at staggering operational expenses. According to some estimates, each conversation with ChatGPT costs OpenAI approximately 36 cents. That might sound small, but when you have 100 million weekly active users, the math becomes devastating. Here's where it gets interesting for your portfolio analysis. The revenue-to-burn ratio is what pro investors call the unit economics death spiral indicator. Here's how it works. If your company is burning $7 billion annually but only generating $4 billion in revenue, your burn ratio is approximately 2.06. This means for every dollar OpenAI generates, it's spending $2.06. Compare this to profitable tech giants like Microsoft, which operates at roughly a 35% operating margin, meaning they spend 65 cents to make every dollar. The gap is enormous, but wait, there's more context we need to examine. OpenAI has raised approximately $13 billion in funding over its lifetime, with the most recent round in October 2024 valuing the company at $80 billion. At current burn rates, without additional revenue growth, that funding runway extends roughly 2 to 3 years. However, and this is crucial, OpenAI isn't sitting idle. Let me walk you through their potential revenue streams and what they mean for long-term viability. OpenAI's primary revenue comes from the ChatGPT Plus subscription at $20 monthly and enterprise API access. But here's the real opportunity they're chasing: enterprise deployments. When you look at companies like Salesforce, SAP, or Oracle, enterprise software contracts run into the billions annually. OpenAI is attempting to replicate this model by embedding AI into enterprise workflows. Microsoft's strategic partnership, which includes a reported $10 billion investment, suggests they're betting OpenAI will capture meaningful enterprise market share. Take Chevron as a case study. The oil company signed a reported $5 million AI partnership with Microsoft for enterprise AI applications built on OpenAI's technology. Multiply this across Fortune 500 companies, and you're looking at a potential path to $10-50 billion in annual enterprise revenue within 3-5 years. That's the bull case. The question for your portfolio is, what probability do you assign to this scenario actually materializing? Here's where the counterargument becomes critical. OpenAI faces intense competition. Anthropic, backed by $7 billion in funding, is releasing Claude, which many researchers argue is superior for specific enterprise tasks. Google has Gemini. Meta has Llama. Meanwhile, the cost of GPU infrastructure is declining, barriers to entry are lowering, and open-source models are becoming increasingly competitive. This competitive landscape suggests OpenAI's pricing power may be more limited than bulls assume. Let's examine the infrastructure cost problem more deeply, because this is where OpenAI's business model faces its greatest structural challenge. According to semiconductor analyst John Petty, the cost of high-end AI chips has decreased by roughly 30% annually for the past 3 years. This is excellent news for the industry, but terrible news for companies relying on proprietary moats through computational advantage. If chip costs continue declining, OpenAI's infrastructure advantage erodes. Simultaneously, companies like Anthropic are more capital efficient, burning less while achieving comparable results. So here's what this means for your portfolio strategy. OpenAI is essentially in a race against time and capital efficiency. They need to either dramatically increase revenue, significantly reduce burn rate, or both. Let's game out the scenario. Scenario 1, the optimistic path. OpenAI achieves 40% annual revenue growth, reaching $5 billion by 2026 and $15 billion by 2028. Simultaneously, they optimize infrastructure costs through improved efficiency, reducing per-unit inference costs by 50%. In this scenario, they could reach profitability by 2027-2028. Their $80 billion valuation might prove conservative, and investors holding early positions could see substantial returns. Scenario 2, the realistic path. Revenue grows 25% annually, reaching $8 billion by 2027. Operational leverage from increased scale reduces burn to $3 billion by 2028. The company isn't profitable, but has dramatically improved unit economics. Enterprise adoption accelerates, but competition prevents aggressive pricing. In this scenario, valuation might grow to $120-150 billion, representing modest returns from current levels. Scenario 3, the difficult path. Revenue growth stalls at 15% annually as competition intensifies. Marginal cost declines are offset by AI researcher salaries and operational complexity. Burn rate remains above revenue through 2027. The company requires additional funding at increasingly punitive terms. Valuation could compress to $50-60 billion. Early investors might face significant dilution. Now, how should you actually use this analysis? If you own technology stocks with OpenAI exposure, either through Microsoft's stake, potential future IPO positions, or broader AI indices, you need to assess which scenario you're implicitly betting on. Most retail investors haven't even thought about this, which represents either opportunity or risk depending on your perspective. Here's my specific recommendation for portfolio construction. First, diversify your AI exposure. Don't put all your chips on OpenAI's success. Microsoft is already profitable and benefits from AI regardless of OpenAI's specific success. That's low-risk exposure. Second, if you have high risk tolerance and a 5-10-year time horizon, a small allocation to OpenAI's success makes sense, but only if you can afford to lose it. Third, watch the key metrics. Track OpenAI's reported revenue growth, cost per inference trends, and enterprise customer acquisition. These metrics will telegraph which scenario is actually materializing. Finally, remember that the $7 billion burn rate is unsustainable indefinitely, but it's not necessarily a death knell. Companies from Amazon to Netflix have operated at substantial losses while building trillion-dollar enterprises. The key difference is achieving the eventual inflection point.